Good afternoon. My name is Anthony Morrow. I am the CEO of American Eagle Gold. I am also part of the OR Group, and we're presenting OR Day. I would like to introduce you to a friend of mine. His name is Ken Hoffman. I first met Ken when he worked for Bloomberg, running research for metals and mining at the company. He helped start a benchmarking initiative that eventually became MyTrack, and he cares for the industry. He worked at Bloomberg for 8 years. Previous to that, he was in research and private equity, and he's been at McKinsey for the last 4 years. And he's the co-lead of EV and battery metals research. I would like to welcome Ken. Thank you very much for participating in OR Day.
Again, thank you very much for letting me talk about a passion of mine, and that's the EV battery materials area. What I do here at McKinsey is I help lead our group that really looks at everything on the battery demand front, from mine site to the technology. So I care very deeply about where the technology is going, and then I also try to figure out, well, which materials will we need to meet those demands. And we can go through a lot of how this is sort of playing out in the marketplace. This is McKinsey's latest numbers on global demand for batteries, both by application and by region. You can see that the numbers are growing exponentially. And as a matter of fact, every time we come out with these numbers, every month or two, they rise. So it's been quite an interesting ride, and I would expect these numbers to continue to rise. If you look at our 2030 number, for example, we believe the world needs around 2.5 terawatts of power. That's 2,500 gigawatts. And if you look at versus what Tesla said at their battery day back in September, they were looking for 20. A huge difference. And we'll go through this, and people sort of say, well, is Tesla crazy, or are you crazy? And the best answer to that is it depends. And we can sort of go through why either one of these scenarios, either uber aggressive or not, sort of makes sense in the marketplace. When we talk about EVs and batteries, the primary area for EV demand today is cars and EVs, and people sort of say, well, how do you know which technology is going to come to the forefront? And one of the things we've done here at McKinsey is every year we interview over 15,000 consumers around the world, and what's really compelling is whether that consumer is in Norway or Germany or Toronto or California or China, for that matter, it doesn't make any difference what the replies are. The replies generally come back with a pretty simple answer when we ask them, what is the car, or what do you want in an EV? Pretty much what you see is that consumer is going to go out, point at the vehicle they currently have sitting in their car park or their driveway, and they say, give me the same thing. And so what is the same thing? That is a range of around 650 to 900 kilometers and a refuel time of 5 to 7 minutes. That's what they want. And I think for a long time, this industry sort of lied to itself and said, well, really, you only technically need a couple kilometers of range. And if you mathematically put together what is sort of needed, you don't need much range. And charges, you could charge it at home and charge it at night, etc. But again and again and again, when we go back to the consumers, that's not what they want. So I think the good news is now battery technology is coming around to where it can deliver what the consumer wants. And I think those will be the winners in the marketplace. How do we get to high range and quick recharge time? And I think Tesla Battery Day and QuantumScape and a number of these other technologies out there get us there really rapidly. This is sort of our where we see the roadmap for battery technology, where it's been and where it's going. First off, if we look at that very first bar, lithium ion, this is batteries we call LFP. Often you'll see in the press today, people will say cobalt-less batteries. Boy, this is an amazing thing. For the most part, they're talking about LFP batteries, which are actually among the oldest batteries that we have for lithium ions. They do not have cobalt, that is true, but they have very low energy density. They've been repurposed in certain vehicles today, so you can fit sort of more of the chemicals in the same space, so you can get a decent range out of the car, but it's not a new battery, and it's not really that great at chemistry. It's safe, it's understood, and it's low cost. All those things are true, but again, it's not a new chemistry. Where we sit today is sort of in those middle two bars. And those middle two bars are sort of where we've seen cathode material going. And so what we've done so far, and those black bars at the bottom is the cathode of the battery. And the cathode has been, how do we get range? We add nickel. It's pretty simple. We take out as much cobalt as possible and we put in as much nickel as possible. And that actually will give you more energy density. And that's where this market has been heading. Today, we're starting to be like, okay, we're getting towards the end of how much nickel we can put in, into the 90+% of nickel in the cathodes. Now what we need to do is to sort of, mess around a bit with the anodes. And you've seen a lot of the new technologies that we've seen over the second half of 2020 really talk about nanotechnology. Anodes currently and always have been graphite. Graphite is great. It's understood. It's very low cost. It's very plentiful, but it really doesn't hold a lot of electrons. It's not the best thing in the world, and it's quite heavy. So how can we sort of improve that? There's two ways to improve that. There's silicon, and we've been slightly adding bits and pieces of silicon to graphite, up to about 5%, and that's okay. But if you add a lot more silicon than that, yes, you can get a lot more density and very low weight. Problem is it expands and contracts a lot and sort of breaks the battery apart. The other way is to use lithium metal. And lithium metal can hold a heck of a lot of electrons, and it's very, very light, but it also has a huge problem with cycle life. They don't last very long. You can go into a lab and you can put out some numbers that look spectacular, but then you realize, your car would last a week and then it would die. So how do we sort of overcome these challenges is sort of going to tell us where we're going to go. This is one thing that sort of shows how we've sort of gone really down in cost. These are some numbers that I grabbed from Bloomberg New Energy Finance, which sort of shows actual deals in the marketplace. And what we've seen is really over the last few years, the cost of stationary batteries, this is stationary batteries, has gone from around $800 to around $100. And that incredible drop is something that could happen in the future. And I think that was the big aha moment for Tesla. Is Tesla said, we're a little bit over $100 now, we're going to drop that to 50. And you can see by this chart that, if we go to 50, by far the lowest cost of electricity storage will be batteries. And I think that's why you've seen a lot of the hype. That's why you've seen a lot of these equities really catch fire, is wow, we actually are at the point that without any subsidies or things of that nature, we could actually have a better mousetrap with batteries over sort of carbon. And that type of excitement has been driving this industry. What did Tesla actually say for cars? This is where where we sort of sat pre-Tesla Battery Day and where we think things could now go with these new advances in technology. If we looked, back around 2020, the average cost of a battery pack in a car is around $120 or so for average. Best in class we knew was around $100, and you probably remember if you followed this industry at all, a lot of people believe that around $100 a kilowatt hour is sort of where a battery car can be equivalent to an internal combustion engine. Tesla said they would drop that number very significantly, pretty much down to about $50 a kilowatt hour. So again, being really, really low cost battery. What Elon Musk talked about was a $25,000 vehicle without any subsidies that would give you your 600-700 kilometer range, would be driverless, would have all the new technologies in the world. It would be a really compelling vehicle if they could put that out there at a profitable level. We sort of looked at everything that Tesla said, and we sort of believe that the easy stuff that they could probably do, increasing their battery size, tablets, a lot of the different things that they mentioned, our battery PhDs believe are pretty easy to implement in a commercial sense. We think some of the things they talked about new methods of mining lithium, of going after nickel and reducing sort of some of their cathode material will be a bit more tricky. And so we're waiting to see how that sort of works out. So we think they could probably get about half of what they say, still incredibly competitive. $72 a kilowatt hour would still be industry leading by a long shot. And we'll just have to watch how they come out with all the things that they're talking about. Now, how does this actually meet into the metals area? Overall, when you look at nickel, and I think nickel is the one thing that we get the most questions on by far, we can sort of see like, well, there's quite a bit of nickel out there. Why is nickel 18,300? Every analyst out there was calling for massive surpluses this year and that the price would be down around 12,000, 13,000. What the heck is going on with nickel? And I'm looking at the supply demand numbers. this sort of doesn't make sense. The problem is you can't really look at the overall number of nickel. You can't look at all nickel because nickel comes in many different shapes and sizes. What we have sort of put out there a number of years ago is there's class 1 nickel and there's class 2 nickel. Class 1 nickel is really the only type of nickel that you can use in a battery. This is your LME grade, this is your NHP, this is your nickel powders, very, very high grades, detriments that are parts per billion in terms of how stringent they are, versus class 2, and your class 2 is going to be your ferronickels, your pig nickels, things that have very high iron content, beautiful for making stainless steel, but really bad for making a battery. The worst thing in the world is you want iron in the middle of your chemistry, particularly for an NMC battery. So when you start to segregate those type of nickels, what can be used for batteries and what cannot be used for batteries, you realize we're already pretty much in deficit in the battery market, particularly since, this chart I haven't updated. You see the little downdraft in 2020. Well, now take that number up quite a bit, because it does seem that over the last 3 months of last year, EV sales just absolutely exploded. If we looked at where our numbers were back in June of last year, I think ourselves and everyone was sort of looking at the trends and saying, okay, EV sales will probably be down about 10 to 20%. All of a sudden in September, EV sales just went on a tear that we've never seen. And last year probably ends up to be up around 20 or 25%. So a massive sea change that occurred in the world, huge increase in demand in Asia, particularly China, really, really big increase in sales in the European Union, where you saw, Germany went from around 2.5 to 3% of their marketplace being EVs in 2019 to 10% of the marketplace being EVs in December of 2020. And so that type of massive increase in sales will come through, and that's part of the reason why we've seen nickel prices move so much, is because it's really become a major part of nickel demand in the world. It used to be nickel was 50, maybe 100,000 metric tons of demand. Now you're getting at over 200,000 metric tons of demand, heading very quickly to 300,000 metric tons of demand, which on a chart of 1.5 million tons is very, very significant. And that's why we're seeing this. And so we've said for a number of years, we believe nickel will be the first pinch point for battery materials. And we think this is something that the industry is really going to have a hard time trying to overcome. And so that's a really interesting thing to look at. If we look at what part is sort of stainless, you can see the stainless market's relatively flat. As a matter of fact, we could actually see a decline in nickel going into stainless. As the price of nickel moves higher and higher, it could see some substitution, whereas the nickel part here is just really rapidly expanding. And again, this is our numbers on what we told you about it at a 2.5 terawatt hour. Imagine if a Tesla is right at 20, this number really explodes and really causes a pain point for the nickel market. Now, lithium is a bit different. Lithium already is a battery material. More than half of lithium in the world already goes into batteries. But there are many different types of lithium. And so trying to understand, is lithium market looking good, bad, or indifferent, it's really hard. But we've seen very similar impacts. The price of lithium has more than doubled over the last few months because, again, of this huge increase in EV demand. And so, therefore, you've seen a lot of excitement come back into the lithium stocks. For example, had a great second half of the year. And part of that excitement was, the expectation that prices would really take off. And really in the last 2.5 months, they've really headed significantly higher. If we look at what's going on in the lithium market, a lot of people don't get very excited here because if we look at the capacity that's in the marketplace for lithium, it looks like we're in vast oversupply. And as a matter of fact, we are in vast oversupply. However, I think, again, just like nickel, that's very nuanced, what we have to look at here is lithium is very nuanced. There are many different types of lithium products out there, and certain lithium products could be very oversupplied for a period of time, where other lithium products will be incredibly tight. And so for lithium products, you have lithium carbonate, which had been the traditional material used in batteries, lithium hydroxide, which is generally used in very high nickel batteries, and then lithium metal. And lithium metal, we believe, will be used in a new wave of solid-state batteries. So if we start looking at these markets together, you can see how the movement from carbonate, which had been really the market for a very long period of time, into hydroxide, which is a lot of what's going on in in Australia. A lot of those spodumene mines, Greenbushes, those type of mines are producing hydroxide, and then metal. And metal could be probably the most value-added area because lithium metal today is a kilo market. You should buy it literally by the kilo. When we start talking about hundreds of thousands of metric tons, that really, bam, that's a huge marketplace. And that could be something that could really change the dynamics out there. And it could also change the dynamics about which mines or which operations are profitable today and may not be profitable in the future. So, for example, brine operations, which may be hurt by a move to hydroxide, actually could be very helped by a move to metal. So all these things are nuanced. There's a lot of things going on. The market is getting much, much better. Again, we're looking for about 2 million metric tons of lithium demand by 2030. And again, that's based on that 2.5 terawatts. The number could be significantly higher. And then lastly, I just want to talk a bit about cobalt. Cobalt was probably the first metal we saw a significant rise. The rise from $15,000, $20,000 a metric ton, all the way up to close to $100,000 a metric ton. And at the time, you did see people really get very, very excited about cobalt, talked about new markets and new pricing regimes, etc. The problem was, number one, batteries don't need cobalt the way we thought they did. And so, 90% plus of cobalt already has been thrifted out of batteries, and there's a small amount still necessary, but that number continues to get smaller and smaller and smaller. And then secondarily, the industry acted very rapidly to put more cobalt out into the marketplace. We did a lot of work on operations with companies who sort of were favoring copper production over their cobalt production, but then switched around and said, how can I set up my refineries to maximize cobalt production over copper production? That brought significant new material onto the marketplace, and the fact that so much cobalt had been thrifted out of the batteries led to that decline in the cobalt prices. Now we're starting to see an increase again in cobalt prices. We haven't completely eliminated all batteries from using cobalt. There still is a bit in there. However, this is something that we think will continue to be thrifted out as new technologies sort of come to bear. If we look at the market, we see the market for cobalt tight, but definitely not the type of deficits people were talking about a few years ago. And so overall, we think the market here for cobalt will be pretty good. And the other part about cobalt that a lot of people are starting to understand is because cobalt's relatively high in old batteries, 33% of old cathode material was cobalt-based versus today where it's only 2-3% cobalt. The old batteries, as they're recycled, will have a huge amount of cobalt relative to new batteries and bring that recycled material back into the marketplace. And whenever you talk to an OEM, for example, they often are talking about the idea of how can we recycle things. And one of the things I want to bring up is a question we get often from mining companies and from investors. They want to look at the value chain and they want to know how can I join this party looks great. You convinced me. Prices are going lower, and for batteries, the metals are going to be in demand, and I really want to get involved in this. What we often tell to the mining companies is, your geologists are important, but for this business, there's an equally important group, and that is your commercial side. Because car companies, these batteries are very, very tricky. The industry only has been around for about 8 years. Batteries technology has been changing so rapidly, and it's a very delicate balance of making these batteries. Every time a new chemistry comes into the marketplace, there's more than a 30% rejection rate because there are certain very small detriments in those chemicals that are coming in that are sort of messing up the batteries. And so a lot of the cell makers and the OEMs really want to get themselves into long-term agreements with miners so they really can understand your ore body, your detriments, so they could really refine their processes so they don't have such a high rejection rate. And so having just a commodity product thrown into the marketplace will actually get a significant discount. Lithium has been most notorious for this. They have a very, very high quality lithium product that is used by the cell makers and really can really give them the best quality product out there. And then they actually get a pretty significant premium relative to some of the companies who are just ultra low cost but don't put out a great product. And that's something that I think really needs to be understood by the companies. If you have to get into this industry, really build out your commercial team. It makes it a bit easier because you can sort of show your ore and what you could provide, get that agreement, and then use that agreement to get back into the business. For example, that's what Piedmont did with Tesla. Piedmont was sort of sitting there trying to get their project developed. Tesla comes out and pretty much says, we want to buy from you on a long-term contract. And then Piedmont, it seems like they're using that to raise some capital to get their mine off the ground. And I think that's something that you'll see quite a bit going forward. But it's something that, it's a new type of value chain. And so, a generic producer of low-cost material will be surprised because they can't get themselves into that marketplace, and they won't get that premium. Overall, we do also put in here, and this, we're happy to send this presentation out to anybody. If you want it, just please ask us or ask Tony. We can get this to you. But there's just a lot of, again, batteries are going to be a major driver. But again, it's a marketplace we'll have to see, just how much of a deficit we'll see in something like cobalt. And that's sort of where we stand today.
So Ken, that was a really great presentation, and let's start off with some Q&A. I guess my first question for you, I knew you at Bloomberg. You covered the gold space. You covered copper. You covered all metals and mining, but right now you're specializing in EV and battery metals. Why did you go there, and what made you make that move?
Sure. I mean, coming to McKinsey was really interesting and very different for someone who had spent their entire life on Wall Street. That's sort of a different kettle of fish. But one of the things I was excited about was coming to McKinsey was sort of building my own group again. I mean, we built something really great at Bloomberg. And when I came here, I sort of had the opportunity to look around and see what was the industry going to look like over the long term. And I quickly came down to electric vehicles. I spent a lot of time looking at the numbers and where the numbers were heading, spent a lot of time talking to a lot of our experts around the world, and also spending a lot of time talking to our mining experts, like 300 mining experts at McKinsey. And one of the things that quickly appeared to me was like, EVs are going to come down drastically in costs. And if they do come down drastically in costs, then we're going to need a lot of different things for this energy source than we have with carbon. So we wrote an article about 3.5 years ago on nickel, where we said we thought nickel would have a major problem because the part of the battery that stores the electricity is nickel, and we thought that cobalt could be thrifted out, which it was. And then we started to go into mining and starting to realize, well, as we talked to the cell manufacturers, there was only certain types of nickel that they could use, and we really came down that there really is a class 1 and a class 2 nickel, and that class 1 nickel pool is relatively small, and therefore if EVs took off, this would be something we would have to spend time on. And then we also have to think about even beyond that, which is, well, if you use up all the nickel, where do you go from there? So I spend most of my time, in that beginning part of the value chain. So from the mine site through the refinery, all the way up to the battery technology, because I need to understand the technology to sort of understand what materials are needed. And the great thing about McKinsey too is we cover, where before I'd only really covered mining. Here I get to cover the world. So I talk to an automaker one day, an energy company the next day, a cell manufacturer the day after that, a utility, a refining company, et cetera, back to the mine. And that gives me a pretty great understanding of the entire value chain, who's doing what and how that's working. And it helps you to advise your clients on what you think is going on and structure, what they may want to do. And then also understand, like, boy, this is going to be a mammoth challenge for the global industry.
It's very interesting what you said, Ken, about the different classes of nickel and how there's a different price. Now, this world isn't getting less ESG compliant. There's going to be continued use of nickel for batteries for EV. Now, if you look at where nickel is produced, the top producer is Indonesia, and you got the Philippines, you got New Caledonia, and if you want responsibly sourced nickel, it really should come from Australia, North America. Right now, Cuba produces more nickel than the U.S. does. So Elon Musk wants to source his nickel. He's talking about Canada now. Is there an opportunity for have a different tier in terms of prices coming from safe jurisdictions that are mining it responsibly?
Yeah, and in fact, actually, I have a different presentation. Actually, showed at PDAC last year that shows all the different value pools of how you could price your material, and that's working. And a lot of it goes back to regulations. So, for example, just look at what's actually happened today in Europe. We figured out that the average carbon charge for a vehicle in Europe is 15,000 euros. So it's not a small amount. When the car is like 30,000, you have to pay a $15,000 tax just for carbon. It's something that those automakers really look at. And that's why the Teslas make quite a bit of money, because I can either pay the government $15,000 or buy a credit from Tesla for something less than $15,000 and save a little bit of money. And Tesla's done well with that. But I think as we go forward to, as EVs become really important, there's going to be a case where the regulators in Europe are going to say, hey, what is the ESG footprint of your raw material? So, what is the carbon footprint? What is the CO2 footprint? SO2 footprint? What is, does it have any acid leaching? Are you ocean tailing, using ocean tailings? Do you use child labor, et cetera? There'll be a lot of check marks. The auto companies are already starting to put that in, and what they're realizing is they should pay a lot more for material that is ESG compliant as best as possible, and local too, because the longer you need to ship, I think Elon says, quite famously, like an electron and nickel goes around the world 3 times before it actually ends up in a car. That makes sense. So they will pay for it. They're trying to figure out, and we're working with clients to try to figure out what is the number, like, how much more do you pay for less CO2, SO2, et cetera. Ocean tailings is just right out. You can't do it. Child labor obviously is right out. You can't do it. And so that is sort of opening up opportunities in parts of the world that you hadn't thought about before. So Minnesota is becoming really interesting. Canada is becoming very interesting. Australia is becoming very interesting. But what clients are trying to understand is, how can I do this? First of all, I need to make the nickel that the industry wants. One of the first things that really, when I talk to mining clients, I just say to them very firstly, your commercial team is going to be more important than your geology team. And for mining companies, that just doesn't make sense. Like, my geologist runs everything. I need to know the grades and everything else. But if the client doesn't want to buy your material, it's gonna get a massive discount, which some of the lithium companies sadly have learned. That if you have lithium that is high in certain detriments for the battery, they just don't want it. And so you can get a 70% discount on your lithium to the marketplace because your lithium is not wanted. Some companies have gone out of bankrupt down that route. Or on the other hand, if you have, the exact material and these cells are really, really tricky. We're not talking about parts per million, we're talking about parts per billion. So if you have just a couple parts per billion of iron in a battery, the battery doesn't work. It doesn't work very well. So how, what is my ore body composed of, and then who's going to want to buy that material, and how can I refine it in a manner that meets the need of the client? So a lot of people are like, for nickel, do I make an MHP? Do I make a powder? Do I just make a concentrate? The customer is going to probably re-refine whatever you send them. Which, like, nickel sulfate is sort of a tricky one, because a lot of clients don't want nickel sulfate the way they get it. They want it a certain way, and they may even re-refine your nickel sulfate. So you need to work with that client, and overall, at the end of the day, if you look at ESG, if you look at the requirements, if you look at everything that's pushing the automakers to what they need to do, that does open up considerable opportunities in Canada, in the US, and in Australia.
Now, if you look at Tesla, the one thing that I've come to realize that expect the unexpected, believe in Elon Musk, and let's look at the facts. Tesla is as big as the combination of the 10 largest automobile companies. It's twice as big as the 4 largest mining companies in the world: BHP, Rio Tinto, Vale, and Glencore. And another fact is nickel is the key metal that Tesla needs, and that is their bottleneck. Now, is there an opportunity, and do you think that it's possible that Tesla may decide to vertically integrate or fund for the exploration and eventual development of some of these new mines, providing ESG compliant nickel in Canada, in the US?
Yeah, I mean, Tesla obviously has done this before, but Tesla has a lot of challenges. They need to, first they needed to go from a company that made tens of thousands of cars to hundreds of thousands of cars. Now they're trying to ramp up from hundreds of thousands of cars to millions of cars. And in that process, they've said they're going to need their own batteries. So they're going to need their own raw material supply. And they need to make their new technologies work. But let's not forget, there's a lot of other companies spending a lot of money trying to do different things. And I think from a mining standpoint, you really need to understand what these trends are going. So for example, I hate when people say Tesla killer. I think that's just a stupid term, because you're not killing Tesla, you're going after the internal combustion market. Why would I care about being a Tesla killer that has 500,000 sales when the rest of the world market's like 99 million? It's like, forget about Tesla, guys. Try to find out what your customer wants in an I think the technologies can get you there. And we talked about that a bit in the speech of, how do I get to a battery that can give me 1,000-kilometer range and that can get me to, recharge time in 5-6 minutes. Those technologies are out there. They're in pilot plants for sure. But what do they need? QuantumScape needs a lithium metal. Lithium metal is sort of sold by the kilo at this point in time. They're going to need hundreds of thousands of metric tons of lithium metal. You're going to need certain forms of lithium. In order to reduce the cost of batteries, a lot of people may not even want a sulfate like they want today. They may take direct powders into their cell making manufacturing. And Tesla sort of alluded to that to try to reduce the amount of chemicals, which reduces your ESG footprint. But the mining company needs to understand, what do they want? What do they need? What are the detriments? And so I think there is this great opportunity, and I think it's going to be beyond Tesla. I think it's going to be, many different vehicle makers, and even Tesla themselves only says, at best case, they'll have a third of the market, which would be massive. Remember, and is that impossible? No, Ford had 60% of the world market back in the early 1900s, so it's possible. But again, there's a lot of these technologies. How do I handle that? How do I be prepared for that? And how do I work with the companies so that ensures my sale of my material through that value chain? I think those are the type of things that the companies need to think of themselves. And by knowing all of this stuff, they'll sort of get where the technology generally is going. Because the technology, right now it's a little bit of a fork where you're going to have sort of a very low cost, probably Tesla product, which gets better range than today, but is much, much lower cost. And then you may have, a solid state battery, which might be somewhat more than the Tesla product, but could even beat those parameters. So you could have, a 1,200, 1,500 kilometer range and, a 5-6 minute recharge time. We don't know yet, but I mean, everyone's trying to sort of position their vehicle as best. But again, how the mining community understands those changes is going to be who's the winner, who's the loser. And big question we get all the time is, okay, if nickel's really going to sort of run out and the price is going to rise, those manufacturers are going to try to move to something else. What's the something else? We think manganese is, looking at the periodic table and what companies are already announcing, Tesla included, and BASF as well. Manganese is going to be really, really interesting metal here. So understand all these trends to position yourself. If I was massive on cobalt when it was 100,000 a metric ton, I made all those investments, thinking, the price isn't going to go down from here. It hasn't worked out for you so far. So you really need to understand where it's going from here.
If you look at I want to talk about supply now. If you look at the Paris Agreement and the electrification of the world, and eventually everyone having electric vehicles, do we have the supply of nickel and even manganese to provide these automobile manufacturers and these companies to build batteries? Do we have that metal, and where's it going to come from?
Well, the Earth has it. It's just a matter of what is the cost to get that material out of the ground and into market. It's going to be, will we accept something like ocean mining? There's plenty of nickel at the bottom of the ocean. Will we accept that? And I think the jury's really out on that. How quickly can we move to a manganese battery? And remember, the manganese market is about 10 times bigger than the nickel market. And a lot depends on technology. And so, if you look at our number, which is 2.5 gigawatts or terawatts, of demand by 2030, Tesla's at 20. So Tesla's almost 10 times bigger than us. And we get often asked from clients, well, is Tesla just crazy? And I'll say it's not a question of crazy or size. It's a question of cost. If Tesla is correct that they can get costs down in a huge, continue this very steep decline of costs that we've seen over the last decade, and remember this industry is only a decade old, then it's really interesting because their numbers are not crazy, because at a certain cost, if the costs are low enough, you'll actually shut down your coal plants, you'll shut down your gas plants, because these batteries, particularly when backed up with solar or wind, your costs are so de minimis at a certain point, if the battery cost is so low, that you would see a massive adoption, and that's where you would see the demand. Now, could we, right now you're only talking nickel's only about $2 a kilowatt of that $100 cost. So if it went to $4 or $5, it still could work. But still, I think that the switch would be on the way where these companies would realize, wow, can we do this? What you're seeing today is a lot of conversations with us. Hey, can we talk to this miner? Do you know someone at that mining company? Particularly of larger assets that could be developed, because people are trying to lock in supply. And the locking in supply, I think, is the big thing the OEMs are worried about at this point in time, to make sure they're not shut out of the market. Because I think the price they could sort of deal with, but they're more worried about is there the proper material even available to them at a certain point if the growth continues at this pace. And I think 2020 really shocked people, because remember in June, you were talking about market being down 15% for EVs, and the actual final number is probably up 25%. I mean, that's just that's really flipping the field, where you thought that, it's going to take a few years to get back to where we were in 2019, to huge increases. And I think that's one of the reasons why you saw the price of lithium, the price of nickel, the price of cobalt even really start to accelerate to the upside towards the end of last year and into this year.
Okay, I can tell you, I looked at Teslas the other day, and I think right now what people are starting to realize, they're realizing that there is going to be a huge adoption for EV, and people don't want to be left in the cold. You want to be in a 4-year lease, and 2 years in, all of your friends and family have EV. So I think that's why you're seeing that big change. Now, we talked about sustainable mining. Now I want to talk about sustaining the nickel price. If you look historically, in 2001, I believe it was nickel's trading around $5,000 per ton. And you look at October 2005, it was $12,000 per ton. Then all of a sudden, 18 months later, in April 2007, it actually hit $50,000 a ton. And then it came crashing back to the earth another 18 months later. Now, I guess the question is, we're excited about nickel. We do believe it's going to go up for all the reasons that you said. And the big increase in that price 13 years ago was coming from China. Now, what are the differences now in terms of the supply and demand? Why do you think that this new price increase can be more sustainable, or will it? Can you maybe speak to that? Because I think some investors are always scared from being burnt before last decade.
Sure. I mean, if you look at what happened after 2000, it obviously was, and it was all commodities. It was Chinese demand. Chinese demand was the black swan that nobody ever thought happened. I remember I wrote a report in 1999, and Chinese steel demand was around 120, 130 million metric tons ish, if I remember right. And I said it would go to 300 million by 2020. And it was one of the few times in my career I actually got hate mail saying, you obviously know absolutely nothing about the world. No economy on earth has seen, from a pretty high level, because China at the time at 140 million metric tons was probably third or fourth or fifth in the world in demand. And they said, you never see someone that big triple demand over such a short period of time. I used to think you had some credibility, and I know you go to China a lot, but nothing. I was wrong. It wasn't 300 million. It was a billion. So China was a huge black swan to the upside. And nickel prices, all metal prices took off because of that. I think that the change to nickel and what really happened was sort of a change in technology, and that was, the Chinese. Everybody knew Indonesia was sitting on massive amounts of nickel, but they knew it was very difficult nickel to process into LME grade material, and so it sat there. When the Chinese sort of realized, like, well, I'm making steel, and iron is really good, and what the Indonesian ore has is a lot of iron in it. And so all of a sudden, this ore that everyone thought was sort of worthless became incredibly valuable, because if you put it in an electric arc furnace and you make it into a mat, it only has 6 to 9% nickel, but that's perfect to make stainless steel. And so when you saw these EAFs just explode onto the scene, it killed the nickel price, because everyone's putting in these multi-billion-dollar HPAL plants to make this ultra pure nickel, and it's not needed. You can just take the dirt out of the ground, throw it in an EAF, and for a few $1,000s, you have a nickel substitute product in that kind of market. What's different this time? Look, there could be a technological change. If you're some of these analysts, particularly in Asia, they're like, look, the demand's going to grow like crazy, but the Chinese are building HPAL plants. Can they do with HPAL plants the same things they did with EAFs? Our view on that is a bit mixed. HPAL plants are really, really tricky. And nickel is, we have a mine span product where we sort of build up a cost curve on every single metal in the world. And for most metals, there's only a certain amount of process routes. So we try to figure out, what is the grinding material, what does the flow sheet look like, and everything else. And when you look at, copper, there's a few dozen type of flow sheets for that. When you look at gold, there's, a bit more, number of flow sheets for each mine. When you go to nickel, you need a different flow sheet for every single ore asset on Earth. We have a different flow sheet for every single asset because these assets are so tricky, so different, all have different detriments, and precipitating out that nickel is really, really difficult. So from that standpoint, does that mean you can just cookie cutter put in these HPAL plants and just produce tremendous amounts of nickel from Indonesia? Maybe, maybe not. That's probably the single biggest question about mining analysts. Our sort of view is sort of halfway. We believe that yes, they'll be somewhat successful, but there'll be challenges, as all these power plants have, in their 60, 70 years of existence have had challenges. And so therefore, it'll be in fits and starts, and it won't be such a cookie cutter approach because, they'll have to be dealing with all these, dealing with a bunch of different ore variabilities, dealing with, the heavy amounts of acid that they'll need, not being able to ocean up. They're going to have to do dry stacking, which is quite expensive. There's a lot of different things here that I think could, see the arrival of Indonesian HPAL, but it will have some negative consequences. And on top of that, what is the ESG numbers about that? You're shipping that nickel, particularly if it's going to Europe or the US, a long way, and that's included in your cost. All of that, the transportation ESG requirements. So there's an awful lot of things there that I think sort of make this time could be a little bit different than last time. And again, it depends what's the demand. If the Chinese, if demand is only going to rise a few percent a year, then there's probably plenty of time to get these HPALs sort of accommodated and up and running. If we saw what we did last year, where nickel was probably over 200,000 tons to the car market last year, to EV market alone. And maybe that goes to, you're hearing China saying their demand could be up 50% this year. So then you're talking about more than 300,000 metric tons of nickel, the class 1 material. If it grows at that type of pace, it would be very difficult for these new plants to sort of ramp up as much.
Now, staying on price, is there a sweet spot for the price of nickel where it could get to, and it keeps the substitutes from coming in? And what I'm talking about is they always talk about there's a price of oil where it makes sense to have an electric vehicle and pay that increased upfront cost. Now, is there a price of nickel where everyone's happy?
I mean, the number you hear about is probably in the mid-20s. So we're a little over $18,000 a metric ton right now. Most of the majors have sort of they claim, they tell you the story you said. It was at 50,000. We got all excited. We put billions of dollars into this industry, and then years later we had to make massive write-offs, and a lot of those CEOs are gone because of it. I think a number in the mid-20s is enough to bring significant amounts of ore investments through, and not only. If you start bringing out, even in Canada, the US, Australia, if you start bringing out really large amounts of nickel, you start building refineries too. And so you need those capital costs accounted for. So probably in the mid-20s is something that probably everyone could agree with. That would make the mining companies want to invest in bringing that, that new, material amounts of new nickel supplies into the marketplace. I think once you get into, like the mid-30s and above, it's a huge incentive for the automakers to find other materials other than nickel.
Now, Ken, I knew you from when I worked at IAM Gold and you worked at Bloomberg. And again, you brought all the gold mining companies together, helped create a Bloomberg platform, which eventually became MyTrack, which is owned and run by the miners. So I'm interested in your take of gold. And regardless of the price, nickel might be down, iron ore might be down, people lose interest, but it doesn't matter where the price of gold is. Everyone wants to talk about it. And I know everyone's always interested in different experts' take. So with Bitcoin going where it is and all the printing of money, gold's a hot topic. What's your intake on? I know you can't give price estimates, but where do you think gold's going and why?
Well, I mean, gold continues to be a currency. It is not a commodity. You can't look at it like a commodity. It is a currency. And so the way you look at currencies is you compare them to other currencies. It's purchasing power parity, right? Gold is increasing 2 to 3% a year in its global supply. And when you see the US last year add, I think it's close to 25% of its money supply, you've seen China continue to ask at 25 to 30%. You've seen even Europe, because of all their expansionary programs, because of COVID, see massive increases. That's a huge tailwind behind gold. And so, I think gold is looking really good. It had a decent run last year. It was up about 25%. But I think, one of the things that we used to do at Bloomberg was sort of track the US dollar in gold terms. If you took all of M2 and divided it by all the gold ever mined in the world. And so I look at that number every once in a while, and I think that number right now is something close to 7,000. When gold was last, a decade ago above, 1900, at that point it was just above what that M2 number was. So you've seen that much, massive increases in M2 over the last few years, and so therefore its number versus gold is really increasing. So that sort of tells you, gold seems cheap. How you do gold versus Bitcoin, I don't quite get Bitcoin, so maybe I am too dated for that. But I do know that there's a scarcity figure with gold. You did see Russia come out for the first time ever. They have more gold reserves than dollar reserves. And I think gold continues to be very important in a number of current countries around the world, particularly in the Middle East, particularly in Asia. And so so that's something that's going to be really interesting, and I think a compelling factor behind that. Add to that a lot of the big gold mines are depleting, just as you're seeing in a lot of metals. So just hasn't been a lot of investment here. The mining industry has really been deprived of investment over the last 10 years. And the gold industry is sort of included. You remember, Tony, when the price fell out of bed, everyone was firing everybody, and the exploration staff was the first ones to go at most companies. So that's still yet to be rebuilt. So when you look at the cupboard, it's fairly dry. And so you don't see a heck of a lot of new supply coming online, even though the price has 1,000 last year. So be really interesting to see. But I think gold is does have some tailwinds, and the headwind would be when all this debt happens, how will these governments, now that your debt levels are just through the moon, can you let interest rates rise? Because if you see inflation, the normal response is to increase interest rates. If you increase interest rates, then the deficits for these countries will just rise that much more because they have so much debt out there. And you don't see it now because the interest rate is pretty much zero. But if the interest rate needs to rise, how are these governments going to handle that? That's sort of the big question for the next 10 to 15 years. But I think gold at the end of the day sits there and says, hey, I have no central bank to worry about. I am recognized globally. I'm one of the most liquid currencies out there. So it can be pretty compelling.
Now, one of my last questions, Ken, I have for you. Andrew Cosgrove was on Ore Day, as you know, and for the audience knowing up there, Andrew and Ken worked together for 8 years. Andrew was his protege, and now he's running metals and mining research at Bloomberg. And one of the questions I asked him was, besides speaking about copper, which he was, tell us about a metal that really interests you, that the market and the audience might not kind of think about. And what he talked about was tin. Now, I want to pose that same question to you. We've talked about nickel. We talked about manganese and even gold. Can we maybe just touch on one interesting metal?
I think, one of the interesting questions, I don't know whether it's going to work or not, but we get asked a lot about vanadium. There could be many ways to close the power gap, and vanadium is an interesting one. And vanadium, until really last year, was an interesting concept that never really had many people putting money into the research. But last year you saw Saudi Arabia and some German companies put a heck of, starting to put billions of dollars into research for vanadium. So if they can, vanadium doesn't have a lot of energy density, but it's sort of, endless cycles. So if you had a vanadium flow plant, it basically could last forever with very little maintenance. So vanadium is sort of one that we get a lot of questions about. If I tell you where our questions are coming from, in the energy part, it's vanadium. From a minerals part, we get a lot of questions about rare earths. Quietly, rare earth prices have really zoomed up over the last few months. So those are sort of the two areas that we get an awful lot of requests about outside of sort of the traditional battery materials. So that's sort of that. I mean, we do get asked gold a lot, and then we get asked a lot about copper. How can we electrify in order to meet this need? And there's going to be a heck of a lot of copper needed as well to electrify the world. So they're sort of the main ones. Rare earths are tough because most rare earths go through China, and a lot of people want to set up a non-Chinese value chain. And how do they do that? Vanadium, there are only a few players, but there's a lot of utilities that are sort of saying, could this make sense for me? So that's sort of how those are sort of the popular topics. I have not gotten any questions on tin though.
Well, thanks a lot, Ken. And one final question, and I want to make it a little fun. I know you're from Albany, and besides sharing an interest in metals and mining, you also love the Bills, which I love. What's your prediction for the weekend?
Well, I have two thoughts about that. Being an analyst, to be fairly honest, I am very hopeful. I love our quarterback. I'd love to go to Super Bowl number 5, and I'd love to go win it. But we'll see. I mean, I think. But I'm very proud of Josh and the boys up there. They gave me something to be really excited about during COVID, and it's a likable team. It's a very likable team, which is something that's really great in sports. So I got my championship hat. I got my Jim Kelly guy here. I got my Jim Kelly signed football in the basement, and we're quite excited. It's given some ray of positivity in these really tough times.
Well, thanks a lot, Ken. And there you have it. This is Ken Hoffman, co-lead of EV and battery metals research at McKinsey & Co. I really appreciate you coming on. And I just want to summarize. He is bullish on nickel, gold, loves vanadium, and loves the Buffalo Bills. So we hope to have you next day at Ore Day. And thank you very much for participating. I know the audience really enjoyed it.
Thanks a lot, Tony, for having me.
Thanks, Ken.